Welcome to today's Explainer. We are putting on our expert investment analyst hats today to literally tear down the financial machinery of Fiserv. We're going to unpack their Q1 2026 earnings, decode their aggressive product strategy, and analyze a massive share buyback program. If you want to understand how a legacy fintech giant engineers its growth, builds a massive economic moat, and returns capital in today's market, well, you are absolutely in the right place. Let's get started. We're breaking our analysis down into 4 quick chapters today. We're going to move from how their core product actually generates cash on Main Street, straight through to how management returns that cash to shareholders on Wall Street. All right, Chapter 1, the Clover Growth Engine. Let's look at what's actually powering this machine. So Clover isn't just some side project for Fiserv, okay? It is the main event. With gross payment volume nearing $300 billion annually and revenue jumping 27% year over year recently, management has set a massive $3.5 billion revenue target for Clover alone. They are pouring heavy investment into software, global expansion, and new hardware. Honestly, they're effectively building a classic Warren Buffett-style economic moat to make this platform the default, indispensable choice for merchants everywhere. But here is the really fascinating strategic pivot. Instead of chasing tiny micro merchants or, weekend side hustles, Fiserv is aggressively targeting what they call quality volume. They want the busy brick-and-mortar restaurants, the bustling salons, the heavy-duty auto shops. They're optimizing for businesses with a heavy, consistent customer flow that literally rely on their systems to keep the doors open every single day. This creates highly stable recurring revenue, which, by the way, is exactly the kind of earning stability that a value investor like Benjamin Graham would absolutely love. And this comparison right here perfectly illustrates why Clover is winning against legacy systems. It replaces your basic standalone credit card swiper with a full-scale business management ecosystem. We're talking real-time inventory tracking, automated employee scheduling, and fully integrated kitchen display systems. It's a transition from a simple transaction tool to a full-time business coach. And from an investment perspective, this creates incredibly high switching costs. Once a merchant is plugged into this ecosystem, they rarely leave. That moat is deep. Moving on to Chapter 2, unpacking Q1 2026 earnings. Let's see how this product engine actually translated into financial results. So, Fiserv's Q1 results presented a bit of a complex picture. While the CFO noted that underlying account and volume trends remained highly stable, the company definitely faced some top-line headwinds as they progressed through the quarter. It wasn't a perfectly smooth ride. To uncover the reality of their operational baseline, we always have to strip away the noise and contrast GAAP numbers against adjusted metrics. While GAAP revenue came in at $5.03 billion, the adjusted revenue set at $4.68 billion. That's a 2% year-over-year decline. We also saw a dip in adjusted operating margins down to 29.7%, alongside a 16% decline in adjusted EPS compared to the prior year. But wait, here is the crucial data point. That adjusted EPS figure of $1.79. Why does this matter so much? Because despite that slight revenue dip we just talked about, this $1.79 successfully beat the consensus Wall Street estimate of $1.57. Basically, management squeezed out way more bottom-line value than anyone expected, even with softer top-line revenue. If we break down exactly how they bridge that GAAP net income to their adjusted metrics, a massive variable jumps out. A $142 million expense for their One Fiserv transformation program. This is a huge multi-year initiative focused on AI, process reengineering, and infrastructure modernization. So, yeah, while it hits the GAAP numbers hard today, this is a highly calculated capital expenditure designed to drastically expand their operating margins tomorrow. Chapter 3, the power of buybacks. We've seen the cash the engine produces. Now let's explore the fuel. To truly grasp Fiserv's strategy, we need to look at shareholder yield. Fiserv currently boasts a massive 12.68% shareholder yield. Since they don't pay a traditional dividend, this yield is almost entirely driven by their trailing 12-month repurchases of nearly $3.79 billion. This is capital allocation 101, folks. They are rewarding owners by literally buying the company back from the public market. And this isn't some sudden knee-jerk trend. Over the last 3 years, their cash buyback spend has consistently compounded, peaking at an incredible $5.9 billion in 2025. In just the first quarter of 2026 alone, they bought back another 3.3 million shares for $200 million. They are a machine. The result of this relentless buying is just profound. they're repurchasing shares at a rate that completely dwarfs their stock-based compensation. Because of this, they've successfully shrunk their diluted share count by almost 20% over the last 5 years. Every remaining share of Fiserv today represents a 20% larger piece of the company's earnings power than it did 5 years ago. Just like Peter Lynch observed with his favorite stalwart companies, it is a masterful way to manufacture per-share value growth.
Finally, Chapter 4, Fiserv's medium-term outlook. Let's see where they are heading. Ahead of their 2026 Investor Day, Fiserv reaffirmed their current year guidance and laid out exactly where they expect the business to be by the end of the decade. They gave us a crystal-clear roadmap of what this machine is capable of producing.
Mapping this out across the timeline reveals a very steady, predictable climb. They plan to maintain a modest 1 to 3% organic revenue growth in 2026, accelerating to a 4 to 6% compound annual growth rate all the way through 2029. But here is the crucial metric for any valuation model. They plan to maintain a massive 90% free cash flow conversion rate. If you're building a discounted cash flow model right now, that sheer cash generation is what makes your DCF spreadsheets sing, and it culminates in a target-adjusted earnings per share of over $12 by 2029. So as you digest all these projections, leave this explainer asking yourself one critical question. Is Fiserv's strategy, pairing Clover's wide moat software growth on Main Street with a relentless 20% share reduction on Wall Street, the ultimate defensive playbook for modern fintech? It really is a masterclass in combining ecosystem lock-in with elite financial engineering. Thanks so much for joining me for this explainer today, and keep digging into the data.